Hey, family. Thank you so much for tuning in. In this week's video, we are going to switch the tempo up a little bit. Now, if you've already subscribed and you've watched each week, you know that typically I focus on a tax issue and how to solve it, right? Or I show you some preventative care to make sure that you don't end up on the IRS. Well, in this week's video, we're going to talk about something a little bit different. We're going to talk about an HSA and how it can affect your taxes. This can be used no matter how much money you make. All right. It's a savings tool that, unlike, 401ks and that type of thing where it caps out or different deductions or credits that you no longer qualify based on your income, that doesn't come into play here. That's what makes it so exciting for me, and I want to share it with you. So, if you're new to me, my name is Timalyn Bowens, and I am America's favorite EA. Give me just a second and I'll show you. So, like I said, typically I focus on tax issues because as an enrolled agent, I feel that my mission is to fill the tax literacy gap one taxpayer at a time. That's why I have a podcast, Tax Relief with Timalyn Bowens. It's also why I have this YouTube channel to educate you to make sure that you can avoid tax problems. But in case those problems have caught up with you, I'm also the owner of Bowens Tax Solutions, which is a Louisville firm. I'm sorry, let me go back. It is in Louisville, Kentucky, but we're a virtual firm based in Louisville, Kentucky, and we specialize in stepping into taxpayers' shoes to help them resolve their tax issues. In today's video, let's stick with the HSA and how it affects your taxes. All right. Before we talk about how it's going to affect your taxes, let's talk about what is an HSA. So, for those of you that do not know, it is a health savings account. This account is a triple tax advantage account. So you may have heard of a 401k, traditional IRA. That has the advantage of it can reduce your taxable income right now. So that's one advantage. For an HSA, it's triple tax advantage because one, it does reduce your taxable income. So the amount that you're taxed on for the year goes down based on the amount that you put in. So if you contribute $3,000 to your HSA this year, for this tax year, your taxable income is going to go down by that $3,000. Number two, it's tax-free when you withdraw. So like I mentioned before, with a traditional IRA, traditional 401k, when you're putting that money in there, it reduces your taxable income today, but when you withdraw that money, you pay taxes on it. A health savings account is different. It's going to reduce your taxable income today when you contribute, and then when you have a distribution, if it's a qualified distribution, I'm going to get to that in a little bit, it's tax free when you withdraw. Uh, and that should not be spelled that way. Charge my head, not my heart, because same concept. You're not going to pay taxes on it when you take it out. In addition to that, you're going to have tax-free earnings. So if you earn interest in your bank account, they send you a 1099 interest form and you have to claim that interest as income on your taxes. Not so with a health savings account. As long as when you make the distributions, follow these rules, the interest that grows your money, you're not going to pay taxes on that either. Now, remember I said if it's a qualified distribution, health savings accounts can be used to pay for qualified medical expenses. And you qualify to open a health savings account if you have a high deductible health care plan. It doesn't matter if you are self-employed. It doesn't matter if you have an employer. As long as you have a high deductible healthcare plan, you can open and contribute to your health savings account. Now, What if something happens and you no longer qualify for a high deductible healthcare plan? That doesn't mean you have to close the HSA. You can still use those funds for qualified medical expenses. You just can't keep contributing to it. So let's look at just a few. With the CARES Act, we have over-the-counter medications that now qualify as HSA eligible. So that means, for example, myself, I'm allergic to Kentucky outside. I found that out the first year that I moved here for college. The pollen drove me crazy. I would be able to go to my local Walgreens or CVS and purchase Benadryl or Zyrtec with my HSA funds. Now, some accounts have a debit card. Some require that you make the purchase and turn in the receipt for reimbursement. It just depends. Another example is prescription medicine. So maybe your doctor wrote you a prescription for something. I know people that have allergies way worse than I do. If their doctor, not their daughter, writes them a prescription, they can pick up that medicine. That also includes inhalers if you have a terminal illness, those types of medications as well. Then also x-rays. Now, this is a very limited list, but I wanted to show you the range of different medical expenses. You can also get things such as Band-Aids. You can pay for doctor co-pays. You can pay for dental exams and cleanings. As a matter of fact, I wrote an article for GoodRx, and I'm going to put that in the comments of this video. It has 77 HSA qualified expenses. So if you have an HSA right now, you're not sure what you can actually purchase with it. Number one, you always want to make sure you check it out with your HSA administrator just to make sure that they will reimburse you for that. Number two, you want to make sure that you're letting your money work for you. So check out the article so you can see the different types of things that qualify to be paid for with your HSA funds. Next, let's talk about HSA contributions because if it's going to lower the amount of money that you're taxed on, it seems like you would put it in as much money as you can, right? Right. Well, the IRS says, wait a minute, my friend. So they actually put a limit on how much you can contribute. So the contributions are tax deductible. As I mentioned before, it is going to lower your taxable income. So the amount of money that you're taxed on. Tax deductions are often confused with tax credits. Tax credits, dollar for dollar against your tax liability. Tax deductions are going to reduce taxable income, aka the amount that you're taxed on. If you would like more information on the difference between the two, I'm going to also include within the description, not the comments. Sorry, I said comments earlier. I put in the description another article that I wrote, which is 15 terms every taxpayer should know. And it explains what a tax liability and taxable income are as well. So for 2023, if you are an individual with an individual HSA, you can contribute up to $3,850 into your account for the 2023 tax year. If you have a family HSA account, you can contribute $7,750 into your account. And then check this out. There's something called a catch up where you can contribute an extra $1,000 into your account. In order for you to be able to do this, you have to be 55 or older. Okay. So let's look at an example. If you've been following the page, you looked at the married filing jointly W-4 video, you know that I like the Winslows, Carl and Harriet. So let's say they have a family HSA. And remember, for families, the contribution limit for 2023 is $7,750. So Carl and Harriet have a family HSA. They contribute $7,000 to their HSA for 2023. So they're good because they're under the limit. And a just side note here, if you give above the contribution limit for the year, the IRS can actually hit you with an excise tax with a penalty for going above that. There is a way to correct it. Not going to get to it into this video, but again, just like I give you guys other information, I wrote an article on what to do if you have excess contributions and how to fix it. I'll include that in the description as well. But for Carl and Harriet, they're good. They're under the limit with $7,000. Now, their taxable income before giving to the HSA was $90,000. And the taxable income is after the standard deduction and all that, okay? So this is going to reduce their taxable income from $90,000 to $83,000. If Carl and Harriet make a withdrawal from this account and use it for qualified medical purposes, they will not pay tax on the withdrawal. They also will not pay taxes on any interest earned while it was in the account. So again, we see the triple tax advantage. They don't pay tax on it when they put it in. They don't pay tax on it when they pull it out if it's for a qualified medical expense. And they're not going to pay taxes on any of the interest earned. Now, if you like this video, you're like, hey, Timlin, do some more stuff like this, or hey, where can I find more information about HSAs that you've written? We need to connect, my friend. So let's connect online. You can find me on LinkedIn at Timalyn Bowens EA, Instagram at Timalyn S. Bowens. I'm not on there as much, but if you check out my stories, that's where I have fun. Also, where you're at right here on YouTube, make sure you subscribe, like this video, and hit the notification button so you know when I put up a new video, which is every Monday night, typically at 8 p.m. Eastern. Sometimes I'm a little late, and charge my head, not my heart. Then I'm on Twitter as well. I put articles out there that I write, and that is at America's Fave EA. So I hope you enjoyed this video. Again, it's a little bit different speed than what I usually do. If you're waiting because you do have a tax problem that you just can't seem to get on top of, I invite you to book a call with me at www.bowenstaxsolutions.com, and we can set up a call to talk about your tax issue, create a plan of action, and see if we're a good fit to work with each other.